Welcome to Growing Empires. I'm Jennifer DeJesus, real estate investor and operator. This show takes you behind the scenes of how real estate assets are executed, managed, and positioned for long-term performance. Let's get into it. LERTA tax abatements and opportunity zones. These are the tax breaks that make or break a deal, and the ones that nobody's talking about. Most investors never think about property taxes, and that's a mistake. Property taxes are the single biggest expense on any one deal. A tax abatement can be the difference between a deal that pencils or a deal that dies. We're going to talk today about the different types of programs that are out there that nobody's talking about, and also the risk that nobody warns you about. So the first one on the list for today is LERTA. What is LERTA? LERTA stands for Local Economic Revitalization Tax Assistance. And it's a Pennsylvania program that was created by the state in 1977. The purpose is to encourage redevelopment of old, deteriorating, vacant properties. Both the local, the city, the county, the school, all have to approve the LERTA. And it does not make your property taxes free. It just gives you a tax abatement. How does it work in plain terms? You keep paying the full tax on the land. That never goes away. But when you improve a property, it gets reassessed at a higher value. Normally, that means an immediate big jump in your tax bill. So if you're looking to buy investment properties and you're looking to make major improvements to them, add units, reclassify the property, all of these things could be the type of area where your taxes will be reassessed. I'm also seeing in certain areas of the Pennsylvania market, taxes are being reassessed on properties even if there hasn't been any significant change. We've most recently experienced this in both the Easton and the Bethlehem markets, where the new owner who bought the property at a premium price because it was a stabilized property, they didn't do any renovations to the property, but they bought it at a higher premium and likely one that is doubled from previous ownerships, are experiencing these reassessments on their properties. So how do you protect yourself as an investor? Number one, making sure that one of your single biggest expenses, your line item in your investment thesis or your investment analysis, has some kind of critical thinking behind it. Are you in a position where you could be potentially on the hook for reassessed taxes? And how long until you get those notices? Some of those things make a good deal go bad very fast. So as an investor, what should you know about tax reassessments? They can happen to anybody at any time. And like any local or state government, they have the power to change their mind and do things that sometimes are not consistent across the board. So back into the LERTA. LERTA phases the jump in the taxes gradually over 10 years. And that is what makes it so important to know if you're buying a property that potentially has the opportunity for the LERTA tax abatement. The exemption will step down each year. So in Easton, as an example, year one, it's 100% of the increase is exempted, then 90%, then 80%, and so on over the decade. So you're getting the improved property now, but you're not hit with the full tax increase until years later. And why does this matter to a real deal? Well, the abatement improves the cash flow in the early years when the deal is the most fragile. If you think about your investments, especially your value add, the first year or two of your investment are always the most critical pieces of your investment. They are the times when you need the most cash flow or to preserve the most cash flow because you're making improvements to the property to stabilize it. Those early years when you're stabilizing, leasing up, and covering debt, any kind of major fluctuation in taxes could again cause the deal to go bad. Lower taxes could be the thing that lets the deal clear its return hurdle at all. So just keep in mind that there are these opportunities out there. Let me give you an example of one that has recently happened in our area. So a developer pitched a roughly 1 million square foot warehouse in the Easton area. The land was generating about $150,000 in taxes while sitting empty. Fully built, it was projected to be assessed around $180 million. Without the abatement to bridge the gap, projects like that typically don't get built. The developer specifically called in a recent article an economic catalyst. It's how challenging sites and environmentally constrained land actually becomes viable for development. Now, LERTA can be impactful to you even if you're not necessarily buying the development or developing the project. you could be taking on the LERTA through your acquisition. I'm currently selling properties right now that have just received their LERTA status because they were fully developed. And that LERTA status will transfer to the new owner for the coming years until the 10-year program runs out for those specific properties. So the risk that nobody tells passive investors, and this is the part that really matters the most. LERTA is approved by local government, and the local government can change its mind. Right here in Northampton County, the county council has moved to repel or limit LERTA deals already on the books. In one case, the prior county executive voted on an extension, and the council overrode the veto. Politics are not certainty, so just keep that in mind when you're looking at deals. If the deal depends on abatement, you're making the wrong deal. An abatement is not a guarantee, and it's not guaranteed to last the full year. So if you're underwriting deals and the premise of the deal actually working is the LERTA or any other type of tax abatement, I would encourage you as a seasoned or sophisticated investor, walk away from the deal. Tax abatements of any kind or tax incentives should never be the difference between doing a deal and not doing a deal, from my advice. What they should be is the catalyst that makes the deal perform better, not the catalyst that makes the deal perform at all. If you're looking at deals where sponsors are underwriting tax abatements, you definitely should be vetting how that sponsor underwrote that scenario and what happens if that abatement gets reduced or clawed back. A good operator is going to plan for that, and a weak one's going to assume that it holds permanent, and they simply do not. I'm telling you from experience, they simply do not. LERTA is about local property tax, and it's not the only program out there. There's other federal programs like opportunity zones, which we're going to talk about now, that work for capital gains. The principle is the same across all of them. Incentives should improve the deal that already works. They should never be the reason why a bad deal looks good. If the only thing that makes the deal look good is a tax break, that's a red flag, not a green light. Keep that in mind as you're looking into some of these incentives. Where can you find some of these incentives? Google is a great resource, but so are your local municipalities. There's a lot of information that you can typically find online through the county websites that will give you some incentives that are in the local areas. Getting familiar with them and then getting familiar with experts in the area that can help you navigate these tax abatements or tax incentives could be very beneficial to your investments. So LERTA is local. It's about your property taxes. Opportunity zones, which we're going to talk about next, are the federal version, and they work on something very, very different, and that's capital gains. So same idea. You use the tax code to steer your investment into areas that need it, but it's a different mechanism. And right now, there's a genuinely strange timing situation with the program that most investors don't know about. So what is an opportunity zone? It's a federal program designated for distressed areas around the country. You can actually find maps online that help you identify what areas are considered opportunity zones. Again, we're talking distressed areas, and we're talking about properties that are going to need potentially a lot of work or redevelopment. But here's the move. You take that capital gain from anything that you have sold, your stocks, your business, other properties, and you reinvest that gain into a fund that develops inside of one of these zones, or you develop yourself if that's something that you do. In exchange, you get two benefits. Benefit one is you defer the tax on your original gain. And benefit two is that you realize the prize. If you hold the investment for 10 years, you pay zero taxes on its appreciation. And that's really key, is that it could be tax-free growth for a decade. And that's really the headline that you want to know. So why did I mention that the timing is strange? Well, the program was set to expire at the end of 2026, but a federal law signed in 2025 made it permanent, but it changed the rules a little bit. And here's the catch. There are two different sets of rules depending on when you invest, and when being the operative word. So if you invest on or before December 31st, 2026, your gain is only deferred to the end of 2026, and you get no basis. If you invest after December 31st, 2026, you get a 5-year deferral and a 10% step up on your basis. An investor who waits to 2027 gets a better deal than the one who invests today. Some professionals are literally calling it the next opportunity zone, or the opportunity zone dead zone. I've actually heard people talk about as they're referring to 2026. The point for you, though, is it might be the right time to wait if you're looking in opportunity zones. But in any type of tax abatement incentive strategy, you want to make sure that you are clearly advised by the right professionals. I am in no way your tax advisor or your CPA, and I cannot advise on whether or not that benefits you positively or negatively and what risks you should think about. But what I can tell you is that if you're not thinking of taxes as a major function in your real estate investments and whether or not those real estate investments are positive or negative and what risks you may be taking with each of those investments, you are missing the mark for something that could change underneath your feet without any warning. There's been a new law that created enhanced benefits for rural zones, and it's a part that's actually overlooked a lot. Rural means that the town or city has less than 50,000 people. But the benefit is a 30% step up at year 5 instead of the standard 10%. That's triple. It substantially improves the project and making many projects a lot easier to pencil. But why does this matter? It's a tailwind that's pointing straight at smaller secondary markets, those tertiary markets and markets that are far more rural. And if you're paying close attention, what you're seeing from all of this is that the tax code is actually telling you where they want you to spend your money. Again, going back to something that I had mentioned previously, why having the right CPA and advisors are critical in your investment journey and not somewhere that you want to pinch pennies. You want to make sure that they are well versed in all of these different types of tax codes and policies that are out there that impact your real estate investments so that you can make the most informed decisions for your real estate investments, as well as be very aware of what your risks entail. So with the LERTA and the opportunity zones, one's on the property tax side and one's on the capital gains side, you really have a lot of opportunity to make good performing deals much better and much more profitable than had you not known about these opportunities that are out there. What should you do with this information as an investor? You should get familiar with the local tax abatements, tax incentive programs that are out there. You should get more information and learn more about opportunity zones and how they work for you. Talk to your tax advisor or your attorney about these incentives and see if you think that any of those could be beneficial for you to learn more about. You certainly can work with your real estate broker or your property manager who may have already had experience in some of these specific areas. And then you want to look to where the deals are that are actually performing in these specific markets. Whether you're investing in some sort of syndication or joint venture, or maybe it's something that you want to go out alone, just make sure that you understand what the tax benefits are going to do to improve your property's overall performance and make sure they're not the single factor that makes you decide to move forward with a deal or not. The tax benefit only works if you hold them for a full 10 years. While you may receive some incentives if you're looking at short-term holds, the intention behind these programs is long-term hold, long-term ownership. Your money is not liquid. The zones themselves can be redrawn over time. So where the money goes matters. Never take a podcast or any kind of blog or article as tax advice. Make sure that you're reaching out to the professionals so that they can steer you in the right direction for your own specific situation. But I'll leave you with some questions in case these things come as an opportunity to you. If you're looking at investment deals, does the deal return depend on the tax abatement? And if so, how much? What happens to your return if the abatement is reduced or goes away? And this is not only for your private investments, but for ones that you're investing in larger syndications. If you're looking at a syndication or some other larger type of acquisition, does the sponsor model the deal without the tax benefit? And does it still work? You want to look at both financial analysis. Even when you're underwriting your own deals, make sure you have both models. You don't need to be a tax expert to take advantage of some of these things, but you do need to know what questions to ask and how to separate the returns based on what is a guarantee and what could potentially change over time. I hope you enjoyed today's episode. You learned a lot about LERTA and LERTA tax abatements and opportunity zones. And until next time, take care. That's it for now. If passive income from real estate investments plays a role in your long-term investment strategy, this show is for you. Thanks for listening, And for more in-depth resources, please head over to growingempires.com.